Hey guys, Freaky Finance here. Weeks ago we looked at Enbridge preferred shares, and this week we're going to look at Wendy's. Wendy's is a fun one, it's easy to visualize. But here you have Wendy's, most people know what it is, especially in America. We'll talk about the business first before we jump into the numbers. So we did do a franchise one, we did minutes a while ago. This one is also a franchise model, largely. So they have 7,240 restaurants, and of those, 6,000 are in the US, so a lot is in the US. You're going to see that when we go through the segments. And of that 6,056.27 were operated by 212 franchises. So very much a franchise business with 403 stores that were company owned. Very much still US centric. That is one of the growth drivers that we'll talk about briefly, but currently you can see very dependent on the US. I did kind of find it interesting that they, this is the first time I looked at this company, so you can see that they sold Arby's back in 2011. In terms of the strategy, again, they want to drive same restaurant sales towards all day parts. So they've been trying to break into morning for a while now with limited success. If they can do that, this will ultimately help the business materially and get same store sales continuing to grow. They're also trying again to become more global. So those are the two I'm going to focus on for today. There's three segments, but again, the one that if you're going to be right on the stock for now, it's going to be Wendy's US. Ultimately, if the growth picks up international, it'll do well there too. But for now, for the purpose of today's video, and because we're looking at backwards looking numbers, you're going to be dominated by US, and this is what I mean by dominated, so you can just see the how it breaks out. It's pretty much 85% these US. I guess the only new one here is global real estate development fees, earns fees from facilitating franchise flips and providing other development related services to franchises. So again, this is also linked to franchises. Wendy's is actually fairly profitable, and you can see that the same store sales have been climbing very well. So 450 in segment profit, 480, 528 year over year. You wouldn't see that in a stock chart. One of the reasons why I'm doing this video is because it's under pressure, and we've seen pressure in the restaurant industry for a little bit now, for at least a solid quarter. So I'm finally been able to look at some restaurants, which is fun. One of the things that franchises have done, and I've noted this for next time we're in this cycle, because I only caught the keg in Canada during the COVID closures. I didn't catch, there's a lot of other ones that I could have bought that are franchise models. And franchise models, because they ride on the revenue, when inflation accelerated, they actually made more money because it was the franchisees that had to eat the cost of inflation, but they got to ride the free royalty up because the royalty is linked to revenue. So, and we'll talk about that in a second as well. So that's something that the stocks probably got right and overreacted to. We've kind of seen a pullback, even in, say, like the Kingpin, like McDonald's, right? We've seen pullbacks in other franchise models. And so I think we're seeing that here as well in a lot of the QSRs, quick service restaurants. Anyway, you can see international is also improving. I mean, smaller numbers, but again, more than 10% a year. And again, part of that is the inflation push. And now they're kind of stuck because they're trying to help their franchisees more. Well, revenue growth is actually slowing because inflation slowed. So we're seeing the multiple come back down, right? And kind of like a mean revert the other way. And so I'm trying to pick them up during that process when revenue growth would be slower than normal, while they're still getting a little bit more squeeze on the inflation side, right? That's when you kind of, in the long term, right? This isn't be like a quarter play. This is be slowly add as these things get sold off more, hopefully. I do own this one, and that is the strategy with it. It's basically just slowly add as it gets weaker, hopefully. And there's a couple in the States and in Canada that I could look at for this idea. But yeah, I do own that one. What else? Yeah, you shouldn't talk about other trades. This is just an active one, and I'm just trying to overreaction to an earnings miss on a relatively bad company, Walgreens. Vail is interesting. We've seen a lot of, maybe I'll do a macro thing, but I've seen a lot of weakness in Brazil lately. And I'm finally getting to some decent prices, like a lot of like Vail's ultimately iron ore linked. We did a video on this a long time ago. And we rode this quite a few times from like the 11 and 10 up to 15, relatively consistently, because it is cyclical. It's going to go with iron ore, and eventually that's going to go back up. Well, it can take a time, so we'll wait for this one. Be patient. But yeah, anyway, do own Wendy's, and the business has improved over time. That's what I wanted to show here. And they say it's improved due to higher revenues, lower cost of sales as a percent, driven by the same factors in the cost of sales, which we'll talk about in a second. And then international, they have been pushing the UK quite a bit, are trying to. That's kind of like their beachhead that they're trying to, if they can get UK right, they think they can start bringing it to other places. A lot of American companies do that first. given the cultures are relatively similar relative to other European countries. Though a lot of English people would probably disagree with that. Here you can see the restaurant growth is expanding. This isn't a shrinking story. This is a growth story with Wendy's. You could read all the restaurant operations if you wanted to freeze frame here. But what I found on page 10 of the 10K was this was kind of more interesting for me because I didn't know this. So you can see they have 3 independent processors. This is so their supply chain. And 5 total production facilities supply all the fresh beef used by Wendy's restaurants in the US, full stop. So that's pretty crazy, right? And they did have 7 independent ones also supplied chicken used in the US. So 5 for all the beef, 7 for all the chicken. So that's kind of interesting, right? And then there's one mainline distributor that serves 67% of the Wendy's restaurants in the US. So there is supply chain. I would say the suppliers have power here still because it's so concentrated. So that's worth bringing up. So normally, like, you're just thinking your Michael Porter's 5 Forces, right? Supply chain actually does. Some of the suppliers here are pretty big. Ultimately, Wendy's is pretty big as well for one of these kinds of guys to lose the client, so they'll probably still have power on them. But it is worth bringing up that it was more consolidated than what I thought it would be. Again, part of that's probably the FDA compliance and making sure that the food that they serve is always compliant with regulations. We don't need to talk about the QSCC. Just freeze frame that if you want. So the other thing that was interesting is the US franchise agreement model, which is how the business operates. I did think it's interesting here. The current agreement provides for a 20-year and 10-year renewal subject to certain conditions, so quite long lease term, or a franchise term rather. And then here there's the franchise fee, so 4% of sales each month. And then the agreement also typically requires that the franchise pays Wendy's for technical or initial technical assistance fee of 50K, some of the startup costs. All right, I always like to look at this for every company that's retail. So this is not a retail play. It's not like Kohl's, which was an easy one in terms of like a valuation backstop. But the properties, like if the business really sucks, they have a lot of value in underlying properties that they could unlock all over America. In Wendy's case, it doesn't have that much. So again, because the franchise model, they wouldn't actually own that many storefronts. They do own their main headquarters in Ohio. It's their biggest space. They do own that, so that's something that if you were in a pinch, you could sale lease back. But it's not like that's part of this play. And then they do have, of the 403 stores they own the land and building for 158 of them. So they do own some. That's worth bringing up. But again, it's not going to be the value driver for these guys. It's not cheap enough for that to be a backstop evaluation yet. But we are seeing relatively strong growth. Again, you have seen the growth slow down, 10 to 2.6. That's inflation moderating. We've seen the margins still expand. And now we're at this point where it might still expand, it might not. It's going to get really small because the franchisees are under pressure while there's still going to be some sales growth from natural inflation. So it'll be interesting to see this. Wendy's has done a good job of writing costs over the last bit. So we'll see that continues. And they're basically putting up about $1 in earnings power now. So, and you can see that here in their guide. So they do have a decent amount of EBITDA, a decent amount of free cash flow after capex, a decent amount of sales growth, and okay earnings power relative to the current valuation of around 16 or 17 bucks a share. So not super cheap yet. It's not like a value call, but it is growing and it's done some things over time. We'll go through the history of the stock in a second just to show you that you're getting a relative value here relative to its long-term average anyway, but not like dumb cheap. So the first thing that they're going to do with their cash is invest more back into the growth. Then they pay the dividend. That's the other screen after is another reason why I'm doing a video. So I was getting at the 52-week low and had a 6% divvy. And I was like, what is Wendy's up to? I've never looked at the company, so I'm gonna take a shot at it. So this is interesting too, and they have been buying back shares over time, but mainly the first two take up the bulk of the cash flow, especially the dividend. It's relatively high for its free cash flow generation. So in terms of the financials, on the bad, here you have the debt. So 2.7 billion, it stands out like a sore thumb here, especially when your only strong assets are goodwill and intangibles, which is never great. So balance sheet strength relatively weak. Not like a bankruptcy risk or something like some of these other QSRs could go, right? But it is weak. And you'll be like, well, why is it weak? I thought these guys made a decent amount of money, right? They have retained earnings. They've paid back $3 billion in common stock over time. Basically, like you can see here, they only have $500 million in cash, 2.7 debt. You can see that they have a decent amount of debt and how it breaks out. You can see the maturity schedule. Next one up is this 357 million. So not it's a relatively well staggered debt maturity schedule until 2029. That's when they're going to see. They're going to have some refinancing risk here. However, the 2029 notes, aside from this 2.37, I mean, we don't really know what interest rate's going to be in 2029. I don't even know what they'll be next year. But they should start coming back down. If they stayed higher for longer, for 5 more years, then we'd start feeling more pressure here. But for the purposes of this video today, based on all available information, this is fine. Because the refinancing risk was pushed out, and they have been paying down their 7% debentures already. So that's the highest cost of capital they have in terms of debt. So they have been reducing debt. It's just slow. The P&L looks fine. It has been growing over time. It doesn't look like this in the latest quarter, but it has been over time when you take out the noise. But the sales growth has slowed. So that's worth pointing out here. It's one of the reasons why I think the multiples come in finally. It's no longer at 20 times earnings like it has been for a long time. It's finally at 16 or 17. So not dumb cheap, but it's getting there. So I want to do the video ahead of time and hope for more weakness. Here you go. So here you can see the cash flow on the latest quarter. Just think there's a lot of noise here. You might be like, oh, 99 versus 52, way better. Wrong. Because of the working capital swing here, like this 25 million right there. What I would do, just for quick shortcuts, if you're ever in a pinch, you just look at this and this, add them together, you get 73. This together, right? Same thing, 77. And then you're like, okay, 4 million better year over year compared to the quarter. Not bad, fine, right? And that makes sense relative to what the numbers we were seeing. And then here you have CapEx that's crept up, and they're starting to support their franchisees more. So some pressure there. So just remember, like 77 minus 21, right? So 51 million worth of free cash flow relatively. What are they doing with the free cash flow? They're largely paying the dividend. So that's this 6% almost comes from somewhere, right? Wendy, yeah, pays 6% divvy. I know that kind of took me by surprise too. They pay a lot of their earnings in a divvy. So just be aware of that. That's one of the reasons why the debt is still relatively high, is because they're paying 200 million basically a year in dividends instead of trying to pay down their debt. So they're purposely staying levered. They do think their EBITDA growth is going to continue to grow and then help them offset the leverage. And then when they refinance, it's not a big deal. But again, you do have that refinancing risk in 2029 if rates are still high, right? Instead of getting their nice 4%, they wanted to borrow at 6 or something, or 7, right? Which would be not good. not the end of the world, but not good. It'll put more pressure on this company for sure. But if rates are back down to low, say if there's another recession or something in that time period, 2028, 2029, again, this time really well for Wendy's segment. We kind of already talked about this at the latest quarter though. And again, Wendy's US, new stores, an increase in same restaurant sales. They are seeing higher check, but it's being offset by lower count. So people, when they come, are paying more, but they're seeing less people. Part of that, again, is inflation. We're seeing more. One of the reasons why the QSRs are selling off is because we're seeing more of the groceries take more share, especially from the lower income. We're talking under 50K. We've seen a lot more weakness still, and this has been more than a year now. Like Alimentation's call, same thing. Especially, they actually flagged the bottom, the southern states in the US, extremely weak. So if you had like a map of your head of every company where they have overexposure to, if you had more exposure in the south, that's probably where you'd see a lot more weakness, where you'd probably be getting some deals right about now. But anyway, we are seeing more and more consumer weakness, but because of the inflation, they're still pulling out ahead slightly. The outlook, so there is some, so here, I mean, they're expecting sales growth, but we also expect cost of sales, percent of sales to be negatively impacted by higher restaurant labor rates. So again, one of the reasons why they're raising prices to franchisees, because they have to pay their people more. They're trying to push through, but again, they're all pushing through on the QSR industry, which is fine. But it's the grocery stores that are going to take share, right? Because at the end of the day, food is food. And if you get priced out, you're going to go to what you can afford, which is the Walmarts of the world, right? And that's kind of like reflected in the market right now, right? You can see Walmart and Costco's 52-week highs, and then the QSR is falling off because they're losing share. We're finally at a point where we're seeing more of that effect. And like I said in other videos, whatever's currently happening, the market over exaggerates and assumes that's going to happen forever. So that's what I like. So I like this, like, okay, that's too bad to be true. Now we're not there yet in QSR land, but some of these are getting there. And so I'm just trying to get ahead of that, because some of these would be decent businesses to own for a while. And here's what I mean. So the weakness is, well, McDonald's 300, 250, right? Decent pullbacks. Starbucks 105, 76. The big guys. There's high growth ones that are just shooting the lights out anyway. Like Chipotle is still a favorite. You've seen Darden hold up relatively well, but again, same weakness, same area last quarter from March to June, just destroyed. Again, restaurant brands, March to June, relatively weak, 80 to 70. The high growth ones, so Domino's, Wingstop, still just growing. And there's other ones, and here's Wendy's dropping from 20 to 16 real quick. So I just thought that was worth bringing up. I'm probably going to do one on Jack too. It's getting cheaper relative to its long-term average as well. But again, a lot of these have debt, and so it's kind of like it's never going to be a no-brainer idea unless it got like really cheap, like 10 times earnings or something, which would be another 60% drop for Wendy's. But it is worth bringing up. That's kind of where my head's at, especially for people that like to see the business they own. I mean, it's very visual business. You see it in every corner. Well, you see it almost in every corner in America and Canada. Not quite the density of McDonald's or Starbucks, though. What else is there? We kind of already talked about the same store sales growth growing, the franchise revenue still growing year over year, again, because it's part of the inflation rider. In terms of the stock, we're almost, the COVID panic, this thing hit 15, so we're at 1666-ish, so that's nicer. Like, I got the signal at the 52-week low, and I looked at it, and I was like, aside from the debt, and then I saw the maturity schedule impact, I was like, I'll take a shot and slowly add, hopefully, as it gets weaker. The business is putting up numbers slightly better, I'd say better than 2018, but you can see we're back down there, and that's with less shares outstanding. Here you can kind of see the revenue growth over time, and you can see that it shot up. The growth rate did shoot up during the inflationary cycle, which is what you'd expect, and so did the gross profit. SGA also did, but you can see overall, in terms of EBITDA growth, you've gone from 350, right, 380, 390, all the way to 530. And they're guiding to something relatively strong for this year as well, 540. So you are seeing steady growth in terms of EBITDA. You're seeing share counts slowly come down with the free cash flow while they're paying a 5.9% dividend yield. So it's not like a crap company or anything like that. It's just not the dumb valuation that I like to get for companies. There is also Trian Fund Management who's in this one. So this is Nilsen Peltz, and you can see that here. He has a concentrated portfolio. He's the Disney guy. He's been in the papers lately. Just a billionaire activist. He's actually owned he's owned Wendy's for quite some time. Let's just see. Yeah, 2011. It's the first quarter he reported it. 14.6%, which that's the same year as the Arby's one. Interesting. I just popped into my head. But you can see that he owns quite a lot of the business. 14.6%. In terms of the transcript note, this is kind of the interesting one, because this is the mindset of the industry right now, right? Because the share price has been under pressure, and so they're basically like, we think value people are getting more aggressive, more promotional, more street fight tactics in the quick service industry. Basically, they're fighting for a share because the share is slowly getting pulled out by the grocery stores as they push price in the fast food channel. So this is what they're thinking. They're like, how do you feel when he's positioned, blah blah blah. Anyway, they're all gonna say they feel pretty good, so we don't read the answer. It's just that's the hate. Basically, the first question is usually what the analyst is feeling the pressure of right now, right? So that's kind of the consensus thought right now is, and to be fair, it has been true. That's why it's in the price, right? That's why it's still getting priced in already. And usually that the price action dictates the narrative, even if these analysts pretend that they're foresighted through it. This would have been a question to ask, like probably a year ago. What else is there? There's growth in store count. They're just trying to get the growth rate for their models. That's all that is. But we've already talked about the store count growth, the trend. Leverage is high, 5.5. They think that the EBITDA growth is going to help them out by the time they need to worry about it. We'll see. I would prefer that the dividend wasn't so high and that they pay off some debt ahead of time, so there's not this big refinancing thing that could happen at 29. They bring up Breakfast again, so that's one of the things that they're trying to break into. We've talked about this. They still had limited success there. It is worth noting that they are growing 3 to 4% same stores on global, so it's not small, but it is a decel. Right? 2-year stack is 8.9. So day parts again, they're trying to gauge how successful they've been. Basically, they're saying, well, Wendy's actually took share in breakfast for the first time because other industries were struggling. We'll see if that holds up or not. It could mean something good here, because again, Wendy's has been limited success in pushing the morning. I did think that I always like the income cohorts because I like to, for all my companies, right? I'm kind of trying to gauge them and where I can find deals right now, like which companies focus on the lower income, which are getting hurt, which should be seeing the share price get destroyed, and is that going to eventually change, right? People don't get destroyed forever in terms of rate of change, right? So anyway, they're basically saying households below 75,000 they maintain share. So sorry, below 75,000 they're reducing frequency and visitations down. On the other end, the higher income consumer, they're maintaining share. They're actually seeing more traffic. So it's kind of interesting. You almost have like wealthier people trading down to lower income consumers would normally consume, and lower income consumers are basically just forced to go where they can and afford, which are your dollar stores and your Walmarts. Kind of sad state of affairs in America, but that's what's currently happening. Commodity basket was interesting. We've seen a big spike in hamburger prices. So again, this was the questions that they were asking going like after the COVID panic, and we saw the restaurants start shooting up in price. The market was like, yeah, you're gonna see inflation, but these guys are just gonna push it right through because it was through the whole channel. It was even in the grocery stores, right? The QSR is good push, and the franchise model works really good during inflationary parts because you just get that uplift in sales growth without getting squeezed with the cost part that the franchisee is. And then eventually it'll catch up. But because you don't want your franchisees to feel too much pressure, you need to support them. So it's kind of this give or take, and one shoots up before the other one does, and then that catches up, and then you get this mean reversion. You get a growth slowdown in revenue, and then the multiple compression, which this is the purpose of the video today. But anyway, again, the thinking's still the same because this guy's hard locked to what happened in the past. And so again, if hamburger prices were to shoot up, you'd see same-store sales growth shoot up, franchise revenue shoot up, and then you'd see the franchisees get squeezed again and ask for more support from the franchisor. Dun, dun, dun. What else is there? I think we're almost done. So again, this is the narrative. So Sarah at Bank of America saying your franchisees perhaps see more margin compression over the last couple of years. Again, because of what we just talked about. And here you can see franchisees are actually happy with the financial progress they made. You grow profits by 9%. Canadians are really happy. They profit grew by 25%. So there's definitely good alignment there. So basically they're saying your narrative isn't exactly accurate. Most of our franchisees are actually happy. So they're only expecting low single-digit pricing for the rest of the year. And then they're saying that they have good value, blah, blah, blah. They're all saying they have good value right now because there is pressure in the value marketing channel, like for promotions. Dun, dun, dun. They talk about UK as the beachhead. UK is a key strategic market, the beachhead for the rest of Europe. I want to get to 400 stores in the UK, which will be interesting to see how they do. Anyway, overall, pretty interesting, but you can see just how when inflation's done right, like how much when McDonald's profited, right? Just for some context. COVID panic, boom, within a year you're up from 200 to 300. It actually steepened the acceleration of obviously one of the best operators in the world. You can see this how the business model rides inflation and how the stock market reacted to it. So it's rate of change positive from the sales growth inflection from inflation push, as well as margin expansion at the same time because they don't feel the same pressure that the franchisees would. And then you have this correction now where they're like, okay, we got to support our franchisees more. Well, we've seen that. And these are not, like, it does look small on the grand scheme of things for McDonald's, but 300, 250 is a decent cutback in just a year, or not even a year, 6 months. So, anyway, what I'm trying to see here is relative value in QSRs for the first time in a while. So, we'll see how cheap they get. But yeah, I'd like to know your thoughts. If there's any other QSR companies you guys want me to look at, there's quite a few that are on my hit list. There's honestly quite a lot of companies that are getting cheaper again, especially in Canada. There must have been a lot of people selling for the capital gains change at the end of June. But yeah, there's like so many trackers that just like hit. I'm like, look at this company, look at this company. So anyway, my attention's being torn apart across a lot of different ones. But anyway, have a great rest of your weekend.